welcome everybody to the April Ellsworth Advisors monthly update. I'm Kelly Keenan. This is my partner Cameron Mealy, and today we're going to start off with some economic numbers, talk about our portfolios, and kind of what we think what we see coming down the pipe over the next 30 to 60 days. Cameron, why don't you kick us off with a little economic update?
All right, thank you, Kelly. Good morning, everybody. Hope everybody is well. On Friday, Bureau of Economic Analysis came out with their first measure of first quarter GDP. It's called the advanced rate, so it is still an estimate, but the current estimate is a 6.4% annual increase in GDP in the first quarter. The consensus estimate on Wall Street was 6.1%, so obviously we're showing an increase in GDP above the consensus. And what's really interesting is if you look now, if 6% holds, you're going to see all of our COVID losses made up since last year, plus an increase in GDP. So in 12 months, we went through the worst possible pandemic shutdown we've seen in our lifetime. GDP decimated in the second quarter and third quarter, and now we've come roaring back to we're producing positive GDP. I mean, it's some things we talk about. It's the resiliency of the U.S. economy. It's the consumer and the consumer spending, and that consumer spending is driven by stimulus and government spending.
Well, I mean, it's amazing that we could be talking about that, just a 12-month window of negative GDP or getting back to that high water mark in such a quick period of time. I think, a year ago we were talking, or 8 months ago, 2023, 2024 to get back to this high water mark. And the one thing with that is, was this a true all-encompassing recession? Obviously not.
No.
And that's just, it's a unique situation that most of us never seen in our lives.
Never. And what's even more fascinating about it is now if you look at second quarter GDP, this again, according to the Atlanta Fed's GDP Now model, it's the model we keep quoting. It's recognized as the best predictor right now of GDP. So the Atlanta Fed, their model as of May 3rd is estimating second quarter GDP to grow at 13.2%, an annual rate of 13.2%. Wow. The consensus estimate right now is 8.8%, which is obviously going to be increasing. So, I mean, yet again, if we're just flat through the end of the year after these first two quarters, we could be looking at
5-6%.
Yeah. Which, in a 2% GDP type economy is quite healthy.
Absolutely.
Now, what is kind of scary about the government spending, the consumer spending, a tight labor market, is obviously we're concerned about inflation. That's right. What we keep talking about. Two measures of inflation that have come out recently. The Personal Consumption Expenditure Index, again, this is from the Bureau of Economic Analysis, increased 3.5% in the first quarter of 2021 versus 1.5% in the fourth quarter of 2020. Obviously, that's a harbinger of inflation. Now, according to the Bureau of Labor Statistics, compensation costs increased 0.9% for civilian workers, seasonally adjusted from December 20th to March 21st. Over the year, total compensation rose 2.6%, wages and salaries rose 2.7%, and benefit costs rose 2.5%. We've heard about how tight the labor market is, particular in the manufacturing sector, hospitality sector. Obviously, we're still doing a lot with unemployment. There's less of a motivation for people to get back to work. So we're really seeing a rise in kind of all of the inputs.
Well, there's some competition, so to speak.
Yes.
Or potential workers have a little bit of a choice. That gets eliminated after September.
Yep.
That may change. I think on the inflation front, I don't know if you have any information, is on the material standpoint. From a material standpoint, that's where we're hearing from our clients that material costs are going through the roof.
Concrete, asphalt,
Right.
Basic inputs, precious metals, steel. I mean, the steel supply right now is so tight. You've got a lot of legacy furnaces that are being put back online.
Absolutely.
I mean, this is going to create pressure.
Well, in the last week, I know of 2 or 3 companies that they bumped their prices starting May 1st. So on Saturday, they're raising prices between 5 and 8% on products. So, inflation's definitely coming. And one of the wild cards, or one of the debates out there on Wall Street, is this a temporary situation, or is this a situation where, we're going to see increased inflation for a period of time here. Yeah. That's kind of what we're facing.
It's obviously being demand driven. So the question is, when the government stimulus and the government spending pulls back, do we see a softening in demand, or is it going to take a significant recession?
Well, it's also supply driven.
Yep, that's true. But is it going to take a significant disruption in the economy to slacken supply and demand constraints?
Right.
And that's a great unknown. So, we're still seeing a very hot economy, again, driven by a lot of government spending, a lot of stimulus checks, a lot of consumer driven. But now, biggest news that we've had really over the last 2 weeks has been President Biden's tax proposals. So let's just run through quickly. The president to the joint session of Congress announced his American Families Plan. It's a $1.9 trillion savings plan. And the funding mechanism is a series of tax increases. So the top individual income tax rate would increase to 39.6%. The corporate tax rate would rise from 21% to 28%. There'd be a 15% minimum tax would apply to corporate book income. American corporations' foreign income would be subjected to a 21% tax. Taxpayers with income over $1 million would pay a tax of 43.4% on capital gains. I mean, that's a doubling of the capital gains tax. That is hugely punitive. You're now going from capital gains in the 20% range to capital gains that rival ordinary income. The step-up basis on death and carried interest loopholes would be eliminated. Caps would limit tax deferrals for realty exchanges like a 1031 exchange and deductions for excess business losses. And, in addition to these tax increases, the president also proposed an additional $80 billion of funding for the IRS with the goal there to go after delinquent taxpayers, collect more tax receipts. So, while the administration and the media is going to tell you that these are tax increases mostly targeted to the wealthy, bottom line is everybody's taxes are going up.
Well, everything always trickles down. I mean, you raise taxes on a corporation or on a business, that could result in higher prices. It shows up in inflation. Yeah. A lot of these, and we're starting to see, I think, cracks in the Biden plan. Just there's starting to be some resistance on the Democratic side of the aisle. And these are kind of like the worst case scenario. I think we're going to see increases in kind of all the areas Cameron talked about, but probably not to the extent of the numbers that Joe's looking for is kind of what it's starting to look like.
And it's interesting because you had right after obviously President Trump was a controversial figure, so right after the election you had a very unified Democratic Party. And there have been a lot of proposals that are not necessarily popular with mainstream Americans, and you're seeing vulnerable Democrats now, both in the House and Senate, are looking to 2022, and they're nervous they're going to lose their job. So we went from very right-leaning president to a very left-leaning administration, and we're seeing that pull back, hopefully, to a little bit more centrist position.
Yeah, this is going to be, I think, a drawn-out battle, and the likelihood of it being backdated to the beginning of 2021, I don't think that is realistic.
Be extremely unpopular.
And even going into 22, if he got his way, the likelihood of the makeup of the Congress and Senate being the same in 2024 would probably be pretty unlikely. So I think a lot of the stuff would be, rolled back come 2024. It's one of those things that you really can't invest around it. It's just being aware of it. How can it change the dynamics? So you have that issue going on, all the massive stimulus going on the other hand. The biggest result I see is, we're looking at some inflation, and there could be some different winners and losers, but we're already seeing that shift in the market already.
But would you believe that if it does look like we're going to see increases in capital gains starting in January 1st, 2022, are we going to see some selling pressure in the fourth quarter?
Oh, I think if it gets to that level, I think you would see a decent amount of selling pressure, absolutely. But the other side of it is, if you exit your stock holdings, the money comes out, the money is probably going to get reinvested.
You got to reinvest it
into other stocks. So it's more of a rotation within the market. Yep. So it's not going to be, it's not going to be a net sell. It's going to be some stuff's going to get sold, some stuff's going to get bought, because the alternative is, everybody's not going to sell their stocks and buy treasury bonds to get 1% for the next 10 years. So
But where they've got the biggest embedded gains, you could see the selling.
Oh, absolutely.
Which could be the FANG stocks, could be the high flyers.
Which will drive the index, because those are they're driving the index now. If those get sold off, the index could look pretty ugly, or it could take a hit.
Yeah.
Let's call it like it is. That kind of ties into what we've been doing with the portfolios. We don't have a lot of concentration in those big FANG stocks. So, I feel comforted in what we have. Yeah, we have some big gainers, but they're not the big drivers of our portfolios.
Right.
So I don't think it's going to kill us, and it really hasn't changed our investment approach up to this point. Now, with changes in the tax laws, moving forward into 22, would we maybe reposition where some of the portfolios are held in different client situations? Potentially, but until you know what the actual rules are, we're not going to make changes in anticipation of something that could happen, because those could become costly. That would not be a good way to go. Speaking of the markets and portfolios, April, another good solid month. In April, the Dow was up 3.55%, taking the Dow to 10.68 year to date. S&P up 5.24% for the month of April, taking the S&P to 11.32. So we had a little bit of a flip there up until this month. The Dow was kind of leading the charge. We've seen a little bit of strengthening back in those tech stocks a little bit, which drove the drove the S&P a little bit higher than the Dow. So we're kind of back to where we were. The S&P's outperforming the Dow slightly year to date. NASDAQ still kind of lagging the group. Year to date, NASDAQ's only up 8.34. Small caps still not as strong as last year, but still up 14.77%. Internationally, the rest of the world hasn't quite caught up to us. I think we're seeing that like in India, where COVID's still a big problem. The U.S. is way ahead of everybody else at this point from a vaccination standpoint, and it's being reflected in the economy. The MSCI Developed World, EAFE, only up 5.63 year to date, and even in emerging markets, which emerging markets were hot last year, up only 4.36%. So, U.S. is definitely furthest ahead, and I still believe the best opportunities are right here in the U.S. at this point in time. From a portfolio standpoint, growth with income, kind of our balanced portfolio. That's where we do hold Apple and Nvidia, some of more tech-oriented type stuff, but we also have bonds in there. We have some commodities in there. Year to date, or for April, we're up 3.15%. We weren't up very much through last month, but year to date we're up 4.5%. So a little ground to make up in growth with income, but once again, it's not 100% stocks. Big winners in April. This is where kind of you see some of the tech, Nvidia up 12.45% in April, Visa up 10.3, Digital Realty up 9.56, Berkshire Hathaway up 7.63. Those are the big gainers for the month. Big losers, Microchip Technology down 3%, J&J only down 1%. Emerging markets, our emerging market fund down 2.88%. So we've seen a little weakness in the emerging markets. Part of it probably due to the India issues. Year to date, our big winners in here, Lennar, 36.65%. We put that in end of the year, beginning of the year, so that's been a nice run. On the commodity side, up 18.51%. Berkshire Hathaway, I mentioned that earlier, up 18.85. Cisco up 15. CVS up over 13. So some good winners there. Year-to-date losers, even though commodities are up, gold's down 7%, which is a little surprising. I mean, that was a good place for us last year, giving up a little bit there. Nike down 6%. Pepsi down 2%. Dividend yield, April 3.6%, year to date up 13.12. Dividend yield is rolling, and part of that is in April, UPS is up 20%, Blackstone up 19.8, Prudential up 10. Big losers in April though, Intel down 10, Merck down 3, British Tobacco down 3, Caterpillar down 1. From a year-to-date standpoint, Blackstone being our big winner, up 39.67% year-to-date, Pru up 30. These insurance companies, we've been holding them. They haven't done a ton for us now. They're starting to work for us. Caterpillar,
colors.
Caterpillar 26.55%, UPS up 22%, so they hadn't done much until this month.
Well, in Caterpillar, how can you, when you have a $2 trillion infrastructure, which isn't $2 trillion of infrastructure, but there is still $600 billion of infrastructure.
There's going to be a lot of building going on.
There's going to be a lot of building. A lot of
sure.
dirt's going to move, absolutely.
Price potential made up some ground this month. For April, up 4.25. Year to date, we're up 8.75. So starting to get some footing. Big winners in April. IQVIA up 21.51%. We actually just sold that for 8% gain. Edwards Life Sciences up 14.2. S&P Global up 10.6. Once again, another insurance company, Allstate, up 10.3 for the month. Where we had pain in April, Whole Logic down 11%, Amgen down 3.69, Mantech down 1.8. So, that's why we made money there. Year to date, our big winners, once again, kind of an insurance theme. In price potential, Aflac up 21.68, Allstate up 16, VMware up 14.67. On the losing side, PerkinElmer, which they're more of a diagnostic company, down 9.58, Mantech down 3.59, Becton Dickinson, also in the medical field, down 2%. Small caps, not as crazy as a month as we've seen in the past. For the month, April up 5.5%. Once again, year to date, we're up 16.25. So, SMID kind of cooled off early in the year, but we're starting to pick up some steam there. Big winners, NovaCure up 54% for the month, Progeny up 28% for the month, Par Technologies up 26% for the month. Losers for the month, Mesa Airlines down 16%. We don't do too much in the airline area. This one obviously didn't work out last month very well. Sonova Energy down 13%, Blink Charging down 10%, Air Transport Services down 10%. Year to date, big winners, Atcor up 90%. Another home builder up year to date, 57% for LGI Homes. Acme up 49%. Proficient up 38%. Progeny, even though we gave up, that's up 38. I'm sorry, that's up 28 this month, 34% for the year. Advanced Range up 33%. Year to date, the big losers, not big numbers here. Pros Holdings only down 15%. Sonova Energy, our biggest loser year to date, down 21%. Addiscare down 9%, and Rapid7 down 9.88. So in general, another decent month. At this stage, we're getting towards May. We're in earnings season. We've had a pretty good strong run the first 4 months of the year. Obviously, I always talk about we could always have a correction at any given point in time. 5 to 10% correction. Is not going to surprise us. It's not going to faze us, especially in the short term because of stimulus, because of the opening of the economy, the improvements happening there. I think any short-term corrections will be short-lived at this point.
And buying opportunities.
Obviously.
Yeah.
So that's where we're at for the month. If you have any questions or want to discuss your portfolios, always feel free to reach out to us. And we wish you have a great May. Thank you.
Thank you.